Hello and welcome back to Money Mastermind. Today we are exploring how to invest at the age of 40. Now let's get started. But first, if you enjoy this content or anything related to investing, be sure to like and subscribe for more videos like this. Now, let's get straight into it. Investing at the age of 40 marks an essential moment in one's financial journey, where strategic decisions can significantly impact long-term wealth accumulation and retirement security. This stage presents a unique blend of challenges and opportunities. Despite any perceived setbacks or missed opportunities, it's crucial to recognize that it's never too late to start investing. In this comprehensive guide, we'll explore the significance of investing at 40 and why taking action now can make a substantial difference in securing your financial future. We'll explore various aspects of investment strategies tailored to this stage of life, equipping you with the knowledge and tools necessary to build wealth effectively. Our journey begins by setting the stage, explaining the importance of investing at 40. We'll dissect the specific financial landscape you encounter at this age, highlighting key considerations and highlights. Understanding these distinctions is essential for making informed decisions and crafting a personalized investment plan. We'll also debunk the myth that investing loses its strength beyond a certain age. Whether you're just starting or looking to enhance your existing portfolio, the principles of investing remain the same, offering ample opportunities for growth and financial security. Throughout this video, we'll provide a roadmap for navigating the difficulties of investment at 40. From setting achievable financial goals to exploring diversified investment options and maximizing returns, we'll cover it all. By the end, you'll not only grasp the importance of investing at this stage, but also feel empowered to take proactive steps towards a brighter financial future. At the age of 40, a critical juncture in one's financial journey unfolds, demanding a thorough understanding of the significance of investing. This section explores three key aspects that highlight the importance of investing at this pivotal age. Before charting a course for your financial future, it's crucial to assess your current financial standing. Examining factors such as income, expenses, debt, and savings provides a clear picture of where you stand and informs your investment decisions moving forward. This introspection lays the groundwork for developing realistic goals and crafting a tailored investment strategy aligned with your financial aspirations. At 40, you face a distinct set of challenges and opportunities that shape your investment landscape. Balancing responsibilities such as mortgage payments, children's education, and retirement savings requires careful consideration and strategic planning. Simultaneously, this age presents opportunities for career advancement, increased earning potential, and asset accumulation. Recognizing these dynamics allows you to navigate challenges effectively and capitalize on opportunities to improve your financial well-being. One of the most powerful tools in wealth accumulation is the power of compounding. By investing early and consistently, you exploit the exponential growth potential of compounding, allowing your investments to snowball over time. Understanding and leveraging this principle highlights the urgency of starting to invest at 40, as it maximizes the time available for investments to grow and multiply, supplying long-term financial security. Do not wait to invest. Differentiating between short-term and long-term financial goals is the cornerstone of effective financial planning. Short-term goals, such as building an emergency fund or paying off debt, address immediate financial needs, while long-term goals, like retirement planning and wealth accumulation, provide a roadmap for future financial security. Balancing both types of goals guarantees a thorough approach to financial well-being, catering to both present and future financial needs. With many financial aspirations competing for attention, prioritization is key to setting achievable objectives. Assessing the urgency, importance, and feasibility of each goal allows you to allocate resources effectively and focus on those that align with your overarching financial vision. Setting SMART goals provides a framework for clarity and accountability, ensuring progress towards desired outcomes. Risk tolerance plays a pivotal role in shaping financial goals and investment strategies. Understanding your tolerance for risk, the willingness to endure changes in investment value, informs decisions regarding asset allocation and investment vehicles. While higher risk investments may offer greater potential returns, they also result in heightened volatility and potential losses. Conversely, conservative investments prioritize capital preservation, but may yield lower returns. Balancing risk tolerance with financial objectives ensures alignment between investment strategies and individual comfort levels, encouraging confidence and resilience in the face of market changes. Asset classes such as stocks, bonds, real estate, and commodities encounter varying levels of risk and return potential. Understanding the risk-return profiles of different asset classes is crucial for informed decision-making. While stocks offer higher growth potential but include greater volatility, bonds provide stability but may yield lower returns. Real estate and commodities introduce alternative investment opportunities with unique risk characteristics. An understanding of these asset classes enables you to diversify your portfolio effectively and optimize risk-adjusted returns. Diversification strategies should be tailored to individual circumstances, including age and financial goals. Younger investors may adopt a more aggressive approach, allocating a higher proportion of their portfolio to equities to capitalize on long-term growth potential. As you approach your 40s, a gradual shift towards a more balanced allocation, incorporating fixed income securities and alternative investments, may be preferred to preserve capital and mitigate risk. Aligning diversification strategies with financial goals ensures a customized investment approach that reflects individual risk tolerance and time horizon. Asset allocation, the strategic distribution of investments across different asset classes, is key for balancing risk and reward. A well-balanced portfolio diversifies risk exposure, reducing susceptibility to adverse market conditions while optimizing return potential. Asset allocation decisions should factor in individual risk tolerance, investment objectives, and time horizon. Regular portfolio rebalancing maintains alignment with target asset allocations, ensuring continued risk management and portfolio optimization. By striking a balance between risk and reward through intelligent asset allocation, you improve portfolio resilience and achieve long-term financial objectives. Traditional retirement accounts, including 401ks and individual retirement accounts, remain cornerstone investment vehicles for individuals in their 40s. These tax-advantaged accounts offer numerous benefits such as tax-deferred growth, employer matching contributions, and the potential for compound interest accumulation over time. Maximizing contributions to these accounts not only nurtures disciplined savings habits, but also provides a reliable means of accumulating retirement assets while benefiting from potential tax savings. Real estate presents compelling investment opportunities for 40-year-olds seeking to diversify their portfolios and generate passive income streams, whether through direct ownership of rental properties, real estate investment trusts, or real estate crowdfunding platforms. Investing in real estate offers the potential for capital appreciation, rental income, and portfolio diversification. However, it's crucial to conduct thorough due diligence, assess market conditions, and consider factors such as location, property management, and financing options before committing to real estate investments. In addition to traditional investment vehicles, you may consider alternative investment options to further diversify your portfolios and potentially increase returns. Alternative investments, such as peer-to-peer lending platforms and cryptocurrencies, offer unique opportunities for generating alpha and accessing non-correlated asset classes. However, these investments often entail higher risk and volatility compared to traditional assets, necessitating careful evaluation of risk-reward profiles, regulatory considerations, and suitability within one's overall investment strategy. Integrating alternative investments judiciously alongside traditional assets can provide enhanced portfolio diversification and potentially boost long-term returns for 40-year-old investors. Dollar cost averaging is a disciplined investment strategy that involves regularly investing a fixed amount of money over time, regardless of market fluctuations. By consistently purchasing securities at varying prices, DCA mitigates the impact of market volatility and allows you to accumulate more shares when prices are low and fewer shares when prices are high. This systematic approach not only reduces the risk of making poorly timed investment decisions, but also uses the power of compounding over the long term, potentially increasing overall investment returns. Rebalancing your portfolio involves periodically realigning the asset allocation to maintain the desired risk-return profile. As market changes cause asset values to change, the original asset allocation may deviate from the intended targets. Rebalancing involves selling overperforming assets and buying underperforming assets to restore the desired allocation. By committing to a disciplined rebalancing strategy, you can capitalize on market inefficiencies, control risk exposure, and ensure portfolio alignment with investment objectives over time. Implementing tax-efficient investing strategies is crucial for maximizing after-tax returns and preserving wealth. Strategies such as tax loss harvesting, utilizing tax-advantaged accounts, and minimizing portfolio turnover can help minimize tax liabilities and improve overall investment efficiency. Also, strategic asset location, where tax-efficient investments are held in taxable accounts and tax-inefficient investments in tax-advantaged accounts, can further optimize after-tax returns. By incorporating tax-efficient practices into your investment approach, you optimize returns and mitigate the decay of investment gains due to taxes, boosting long-term wealth accumulation. Establishing emergency funds and securing adequate insurance coverage serves as the first line of defense against financial shocks. An emergency fund, typically comprising 3 to 6 months' worth of living expenses, provides a financial safety net to weather unexpected expenses, job loss, or medical emergencies without resorting to liquidating investments at inopportune times. Likewise, insurance policies, including health, life, disability, and property insurance, protect against unforeseen risks and provide financial stability in times of crisis. By proactively building emergency reserves and securing comprehensive insurance coverage, you safeguard your financial well-being and mitigate the impact of unforeseen events on your investments. Market downturns are an inherent risk in investing, underscoring the importance of implementing hedging strategies to mitigate downside risk. Hedging involves employing financial instruments such as options, futures, or inverse exchange-traded funds to offset potential losses in a portfolio during adverse market conditions. While safeguarding strategies may include additional costs and complexity, they offer a valuable means of diversifying risk and protecting investment capital during periods of market volatility. In the developing world of investing, avoiding common pitfalls and scams is crucial for preserving wealth and maintaining financial security. You should exercise diligence in researching investment opportunities, analyzing potential risks, and seeking reputable sources of financial advice. Also, maintaining a healthy skepticism towards too-good-to-be-true investment schemes and conducting thorough due diligence before committing capital can help mitigate the risk of falling victim to investment fraud or scams. By staying informed, exercising caution, and adhering to sound investment principles, you protect your hard-earned assets and navigate the investment landscape with confidence. Deciding when to talk to a financial advisor depends on individual circumstances, financial goals, and comfort levels with financial planning. You may consider hiring a financial advisor when facing significant life changes such as marriage, parenthood, career transitions, or inheritance that require comprehensive financial planning. Likewise, those seeking specialized expertise in areas such as retirement planning, tax optimization, or estate planning may benefit from professional guidance. Also, individuals lacking the time, expertise, or inclination to manage their investments may find value in outsourcing financial decision-making to a trusted advisor. Selecting the right financial advisor is a critical decision that requires careful consideration. When evaluating potential advisors, it's essential to ask probing questions to assess their qualifications, experience, approach to financial planning, and fee structure. Ask about their credentials, professional affiliations, and track record of success. Understand how they prioritize clients' interests, manage conflicts of interest, and communicate with clients. Understanding the advisor's investment principles, risk management strategies, and process for crafting personalized financial plans is crucial for establishing a productive advisor-client relationship. Deciding between managing finances independently and engaging a professional advisor depends on weighing the advantages and drawbacks of each approach. DIY investors keep full control over their financial decisions, potentially saving on advisory fees and maintaining a hands-on approach to portfolio management. However, DIY investors may lack the expertise or resources to navigate complex financial matters effectively, increasing the risk of suboptimal investment decisions or overlooking critical planning considerations. Conversely, professional management offers access to specialized expertise, personalized financial guidance, and disciplined investment strategies tailored to individual goals and risk tolerance. While professional management includes advisory fees, the potential benefits in terms of investment performance, risk management, and comprehensive financial planning may outweigh the costs for many individuals. Ultimately, the decision between DIY and professional management depends on individual preferences, financial literacy, and comfort levels with financial decision-making. Staying informed of financial news and market trends is vital for making informed investment decisions and capitalizing on opportunities. Regularly monitoring economic indicators, geopolitical developments, and industry news allows you to anticipate market movements, identify emerging trends, and adjust investment strategies accordingly. Also, staying informed encourages a deeper understanding of the factors influencing asset prices, enhancing risk management capabilities, and promoting financial resilience in the face of market volatility. Financial goals and circumstances evolve over time, necessitating periodic reassessment and adjustment of investment strategies. By reviewing financial goals, risk tolerance, and investment performance regularly, you ensure alignment with changing life circumstances, market conditions, and long-term objectives. Periodic reassessment facilitates proactive decision-making, enabling you to capitalize on opportunities, mitigate risks, and stay on track towards achieving financial milestones. Investing is a journey marked by continuous learning and adaptation. Embracing a lifelong learning mindset involves seeking out educational resources, staying open to new ideas and perspectives, and continuously honing investment skills. Whether through reading financial literature, attending seminars, or engaging with industry experts, ongoing education allows you to make informed decisions, navigate market complexities, and adapt to changing investment landscapes. By fulfilling a commitment to lifelong learning, you improve your financial literacy, optimize investment outcomes, and build a solid foundation for long-term financial success. As we conclude our exploration of investing at this critical stage, let's reflect on the key insights and motivations to embark on a path towards financial success. Throughout this video, we've highlighted the importance of investing at 40 and provided actionable strategies for building wealth and securing your financial future. From setting clear financial goals and diversifying your investment portfolio to mitigating risks and seeking professional guidance, we've covered essential aspects of effective financial planning tailored to this stage of life. Investing at 40 is not just about accumulating wealth. It's about securing your financial well-being and creating opportunities for a fulfilling life. As you begin this journey, remember that every step you take toward financial empowerment brings you closer to your goals. Whether you're just starting or seeking to improve your existing portfolio, the key is to take action, stay disciplined, and remain committed to your long-term objectives. Investing at 40 is more than a financial decision. It's an investment in your future self and the legacy you leave behind. By using the power of compounding, diversifying your investments, and staying informed, you pave the way towards financial independence and create opportunities for yourself and your loved ones. Remember, it's never too late to start investing, and every decision you make today has the potential to shape a brighter tomorrow. So seize the opportunity, take control of your financial destiny, and embark on the path towards a prosperous future. Your journey to financial freedom starts now. Thanks for watching Money Mastermind. If you enjoyed this video, be sure to check out our other videos for more investing tips. Don't forget to like and subscribe to stay updated on all our latest videos, and we'll see you in the next one.